I almost wore my suspenders in your honor because I was wearing
That's what you had
suspenders
the first
back
day.
then.
Do that.
And we're still using it for promotion. I need to, what do you think? Bring the suspenders back from time to time? But everybody saw, I thought I looked like a Wall Street banker, and everybody told me I looked like Larry King. And I don't want to look like Larry King.
Yeah,
I wanted to look like a master of the universe.
Yeah, maybe don't bring them back. Just I didn't think about the Larry King part.
Welcome to the Bill Walton Show, featuring conversations with leaders, entrepreneurs, artists, and thinkers. Fresh perspectives on money, culture, politics, and human flourishing. Interesting people, interesting things.
Welcome to the Bill Walton Show. I'm Bill Walton. One of the goals of this show is to try to explain complicated things in ways we can all understand. Well, one of the things that's moved to the top of my list is money. When I started out in commercial banking in the 1970s, it all seemed pretty straightforward. Now, not so much. Here are just some of my questions. What's a central bank digital currency? Sounds ominous, but is it a good thing? How does the Federal Reserve set interest rates? What's the dollar's world reserve currency status really mean, and does it matter? Can the Fed really do anything to stop inflation? Or does the Fed really think that its mission now is to fight global climate change or to promote social justice? Do we even need the Fed? For some answers, I'm joined again by one of my favorite guests and good friend, Norbert Michel. He's Vice President and Director of Cato Institute Center for Monetary and Financial Alternatives. Norbert has the high distinction of being a guest on my second episode almost 6 years ago, and we had a great time with Jack Spencer. You guys were at Heritage then.
Yeah.
And so we're going to, and actually you were on with George Selgin about 2.5, 3 years ago.
That's right.
Talking about money.
This
And
is my third shot.
Yeah, and the third time is really the charm because the list of questions I've got is crazy complicated.
It keeps getting more complicated, I think. Yeah.
It is. So that's your take too. It is getting more complicated.
I would agree with that. Yeah.
So where do you want to start with my list? Do you want to try interest rates?
I love the interest rate one. Yes.
Okay, let's go with that.
For me. So everybody always says that the Fed sets interest rates, or that the Fed's kept interest rates too low for too long, or some version of that. And I understand why. They do set an interest rate target, but the truth of the matter is they can't just make interest rates whatever they want. So we don't want to give them too much credit or too much blame. What they do certainly affects credit markets, but they do not simply set interest rates. They do administratively set a policy rate now, and that's the interest rate that they pay on reserves, and as well as the discount window rate and that sort of thing, right? But the Fed funds rate means nothing anymore, really. It's sort of a nominal thing. And, when we look out over the broader financial markets, the truth of the matter is what they do does not set those rates. And they are trying to have an effect on the supply of credit, and or you could say the demand for credit by trying to affect the price, but they simply don't set rates. So why that's important is you'll hear many people critique the Fed for example, prior to the 2008 crisis, somewhere back in the early 2000s, keeping interest rates too low for too long, or their zero interest rate policy, keeping interest rates near zero forever. And
I've said that.
And many people will. And many people
correct
will.
me.
But if you look at what they do, okay, and if you look at the way that rates move, they tend to follow rate movements. In other words, they adjust their targets based on what's happening in the market. And they try, and they historically, they have tried to keep a minimal footprint in the markets. Now that footprint has grown, but not because of their strict monetary policy piece. It's because of the emergency lending and the sort of these extra monetary policy type of things that they do now that they didn't do before. There's a reverse repo facility for the money market funds. There's $2 trillion of cash sitting there, right? The Fed's supposed to be the lender of last resort. That's not lending. That's the Fed effectively borrowing money. So they're taking cash out of the economy for that. So that's not a rate setting policy, and that's not a credit setting policy, and it's certainly not monetary policy.
Well, does Cato have a position about what the Fed should be doing or not doing? Well, and let me back up. Let's
Yeah.
do a little history. This is part of a series, I think, of 3 shows so far I've done on money. And, Federal Reserve created when? 1912, 1914,
1912,
roughly.
19, yeah, somewhere back.
And it was a lot of opposition to it, and it was part of the progressive
Yep.
legislation in the early 19 teens or something like that.
Yeah.
And so it was set up actually by a bunch of New York banks who thought they could
Yes.
control the system.
Yes, that's right.
So fast forward to today, it's over 100 years ago. The Fed's powers have grown. The number of banks have shrunk, and it's now finding itself in a more privileged position than ever.
Yes, no doubt. You have the system that was created for one particular thing under the gold standard, under a completely different monetary system than what we have now. Yeah, the idea was effectively to have these reserve associations, these sort of clearinghouses, modeled after what was going on in the private sector, and it was very much a New York large bank driven move to get something that was more stable or solid for them. And look, reserves don't mean the same thing now as they did under the gold standard. This is a completely different world, and it's gotten completely different consistently through time. You have a pure fiat system now, and we have, I would argue, a more important public-private arrangement now, a more definitive public-private arrangement. So you have this weird sort of public piece of this, right? It's the US dollar, but you still have private markets, banks, creating deposits. So when we say things like the Fed creates all this money, that's not quite right. Does the Fed enable a certain amount of creation of money? Yes, but it's not them by themselves.
So why do we spend all our time and ink on the Fed?
That is a great question. We parse the language of the things that they say. We look at Federal Open
Well,
Market
if you're
Committee
trading bonds
statements
up in
and-
New York on Wall Street, you got to pay attention because you're interested in, market signals and things like that. But what
Yeah.
you're saying is in terms of the macro economy, it doesn't really matter that much.
That's right. No, that's exactly what I'm saying. Yeah, it's one thing to be a Wall Street trader and worry about getting 1/10 of a percentage point return on something, right? But the idea that what the Fed is doing is sitting down in a basement and turning some dials and cranking up unemployment or cranking down inflation or cranking up GDP, it's just not true. It just doesn't work that way. And the 2008 crisis is a great example. If the Fed could control things, that would have never happened. The current crisis, or if you want to call it the COVID fallout, with all the supply chain stuff and everything.
That was a crisis.
Oh yeah. Okay. So another great example though, right? If the Fed could just turn some dials and make that stuff go away, don't you think they would? They would.
Isn't the Fed sort of a funny structure though? Because we talk about the Fed. You've got the Fed in D.C. and then you've got the Federal Open Market Committee, and then you've got the 12 regional banks.
Right.
And they perform. There's Jay Powell and the chairman and the Fed in D.C. has become a more prominent spokesman for all this, but it's really a much more complicated system.
Oh yeah, and it's an outdated system.
Yeah.
That was part of the deal that they put it together that way in the early 1900s. It was part of the deal to get
Nobody
it through.
wanted a central bank, and so they
Right.
said, okay, Kansas City, you can have your own bank. Richmond,
Yeah.
you can have a bank. Atlanta, you can have a bank. So everybody got their own Federal
Yeah.
Reserve Bank.
Yeah, yeah. Those different associations, those sort of like clearing.
Now, when I was a
things
commercial
all
banker in
over.
Chicago, I was at Continental Illinois Bank, and it was really very funny because on LaSalle Street, the foot of LaSalle Street, you had the CBO, the Board of Trade, trading all the agricultural commodities. And then the Federal Reserve was on one side of LaSalle Street with all the columns. And just on the opposite side of LaSalle Street was Continental Bank. And they looked exactly alike,
All the
except
same.
the Federal Reserve Bank had Corinthian columns,
Yeah.
and the Continental Bank had to have Doric columns because they didn't want people
Didn't want to-
confused, as if people knew the difference between Corinthian and
Yeah.
Doric.
No, I'd have to look that
So
one up
that,
too.
in those days, you wanted to be marble, you wanted to have
Yeah.
Greek columns, you wanted to be solid.
Inspire
And so that was
confidence.
Chicago's bank. So I digress, but I thought it was interesting.
It is. No, but it's a good point because, we're very quick to say the Fed does this or the Fed does that. And, it's a really weird structure. It is outdated. It no longer serves the purpose that it was originally created to serve. So those district banks really don't make any sense at all. If you look at what they were supposed to be when they started the system, we just don't do that anymore. And
Continental
now-
Bank's been turned into a shopping
And-
mall.
and
I'm
that-
not sure about what's happened to the Fed across the street, but anyway,
I know they're still there.
Yeah.
They are. But the board in the 1930s, the board in D.C. gained essentially complete control over the system. It's only gotten
the
worse.
board in
but
D.C.
The board in D.C.
Federal Reserve Board, okay.
Yeah.
That they control the system as of the 30s.
Yes.
Okay.
At least by virtue of a majority rule. Yes.
Sure.
And it's only gotten worse little bit by little bit over time. I mean, they have so it's really not the case that the Fed is a private bank. Yes, those district banks are not federal agencies, but it doesn't really matter because the Federal Reserve Board is a federal agency, and the Federal Reserve Board is running the show. So, so what you have when you say the Fed is you have this oversight board, if you will, in DC, and you have these district banks all around the country, and they've become sort of these research and advocacy groups.
Well,
There's all kinds of economists, thousands and thousands of economists doing research, and the board has their own as well, and they're feeding policy.
well, they have 1,000 economists. They all went to MIT. They all learn the same models. They
Yeah.
have exactly the same worldview, and they
Yeah.
all wear those little propeller beanies. Or do they? Well, I thought that
haven't-
was standard
no,
issue at the Fed.
That might be right. I'm not sure. I haven't seen the propellers, but so I can't say.
One of my professors at George Washington, when I took a couple of classes there, was a Fed economist. He was the one that made that
Did he?
joke.
Did he? Okay, I was gonna say, did he come
He,
in with the
he didn't
beanie?
have one.
Because-
He
all
didn't
right.
have one. He thought everybody else did. Well, you say something that you mentioned setting policies and writing papers. The 12 banks, you take a look at the San Francisco Fed. The San Francisco Fed has become notoriously woke.
Yes,
And they were the ones that oversaw the Silicon Valley
Yeah.
debacle.
that's right.
And if you go on the Federal Reserve website, I haven't done it quite recently, it's just filled with papers about how Fed monetary policy ought to be bringing about social justice.
Yeah.
And Fed monetary policy ought to be fighting global climate change. And my view is the Fed can't really even do its own principal mission very well, which is maintaining a
That's
strong
right.
currency. So it's got all these mission drifts throughout the system.
Oh yeah. No, we agree there completely. Their main sort of mandate on macro policy, I would say, is also outdated. It's not something that
The
we
Fed's
should.
supposed to, the dual mandate is what? It's supposed to be stable money.
Stable
And the second
prices.
mandate is full employment.
Stable prices, maximum employment, and then there's actually a moderate interest rate one in there too. So it's technically three, but nobody talks about that one, even though they say the Fed sets interest rates.
Well, I never even knew, based on what we're talking about, how the Fed can possibly maintain a full employment economy.
They can't. They can't.
So
And-
it's got
and-
one sitting right there that somebody, politician, thought was a good idea, but it can't even
That's
do
right.
it.
No, that's right. And this came out of the 60s and 70s with the Phillips curve stuff, and
Phillips curves was a trade-off between interest rates and employment.
That's right.
Yeah,
Interest rates,
okay.
unemployment trade-off, and basically right around the time the economics profession was realizing, oh wait, maybe that's not an exploitable trade-off. Congress wrote it into law, so and it's been stuck there.
That's
you
what
know,
Congress
ever since.
does,
So, yeah,
write
yeah.
those really bad ideas into law.
Yeah.
This is the Bill Walton Show, and I'm here with Norbert Michel, a great friend, runs the whole money operation at Cato Institute, which is one of my favorite think tanks. And we spent the last 10, 15 minutes or so trying to figure out what the Fed really does.
Yeah.
and we're still working on it. So
We
so-
might need more than 10 more minutes. But they do. Do you want me to go a little further?
I want you to do whatever,
Okay.
let's
So
follow our cue. Let's see if we can understand what this is really all about.
So one thing that the Fed can do is clamp down on credit, right? They can make credit much tighter and much more difficult to get, and that's something that is possible. They have control over reserve requirements. They have control over discount window lending. They have control over bank funding. There is no doubt that if the Fed wanted to just wreck the economy, they could increase reserve requirements, increase policy rates, and make it incredibly difficult for banks and other financial firms to get funds. That is possible. But the consequences that would come with that would not be good. So they don't want to be in that position. Okay, it's against their interest to do that. And what you will notice over at least the last, I would argue, 50 years, is that what they are trying to do is have an effect on expectations, have an effect on credit markets, but a minimal effect. So in other words, they don't want credit to go crazy. They don't want money creation to go crazy. They want to hold things in check, but they don't want to clamp down on them so much that they completely wreck the economy. And you'll see some of this going on right now with the
Well, aren't they
argument
trying to
over
wreck the
unemployment.
economy right now? I mean, that was one of my questions.
Yeah,
Can the
I
Fed
don't
really
think they
do
are.
anything to stop inflation?
The biggest thing that they can do is credibly show that they are concerned with inflation and that they are going to get back to their 2% target. Now, and they can do that by adjusting their policy rate, but they only have so much latitude to adjust their policy rate. Like they can't just say, we're going to make interest rates 10%. Like that's not going to work. You actually end up with a lower equilibrium rate if you do
Well,
that.
they're also trying to manage the stock market. They've got one eye on the stock
Oh, yeah.
market as they're doing this. I mean,
And then we talked a little bit about their dual mandate, and we didn't really talk about their financial stability mandate. And I've argued for years now that that's a bad idea. So this is another part of it, and this is why they have their eye on the stock market and on other parts of the financial sector.
they don't want to cause a stock market crash.
Yes, they don't want anything messy on their hands.
Yeah.
And this is now. So what I'm saying is, look, they can't even control interest rates. They can't control the macroeconomy. They sure as heck can't control financial markets and stock prices. So what we should not have is a mandate in place that effectively forces them to worry about those things.
Right.
It's counterproductive.
Well, you had lunch with Jay Powell last week. Did he admit
Did.
all this?
I can't talk about that, Bill.
No, but it's pretty good. I mean, yeah, just a couple of you having lunch. He's a good guy.
He is.
I
He
do
is.
think he's
I
running.
like him.
I think he's sitting atop something that's very hard to control.
I agree, and I can't speak for him, so you'll have to get him on the show and ask him. But I do agree with
Do you know
that.
the problem at a show like this with elected officials or with
Yeah.
people who are in administrative jobs? They'll never tell you anything.
Not gonna be a very big discussion, very broad discussion. Maybe when he steps down.
He could be very interesting. Yeah. Well, but we're drifting just a bit. But let's explain financial stability. So you're Jay Powell. You're sitting there.
Yeah.
You think about financial stability. So you're not worried just about interest rates and credit. You're worried about the stock market, the commodities market. What else?
And bank failures.
And bank failures.
Yeah, which is what we saw with the Silicon Valley stuff.
So was the Silicon Valley the failure of the Federal Reserve in San Francisco to oversee it properly, or was it something else?
Oh, it's a lot. I mean, I think you definitely have, and we don't know all the details yet. So I'll preface what I'm going to say with that. But it certainly looks like there were regulatory supervision failures. At the very least, there were some red flags that went up in 2021 and 2022 about the way the bank was hedging its portfolio or not hedging its portfolio. And, you know, it seems like an elementary mistake. It seems like one that was actually flagged for by the regulators, and nothing was done about it. So that we have to get to the bottom of that. That does look like that was a failure out on the district bank, who is the regulator for that.
Well, you have to be more careful than I do because you've got to
Yeah.
talk with all these people. But my understanding was the Federal Reserve of San Francisco had just given Silicon Valley Bank the highest marks for its equity program and its climate program. And that they were just saying the bank's doing a great job
Yeah.
pushing those agendas. And that's not a business I think the Federal Reserve should be in, or a bank should be in particularly, but that's just one.
I share your take in that that's not something they should be doing.
Yeah.
And, you know, maybe it is the case that they were wasting too much time doing those things rather than the actual supervision of the bank and the bank's risk. And, you know, like I said, it does look like there was a literal failure on the risk management side, supervisory wise.
But the financial problem was they bought long-term bonds at a low interest rate. Interest rates went up, and it looks like they were pushed up by the Fed, although we can,
Right.
so anyway, interest
I
rates.
want to come to that, but go ahead. Go ahead.
Okay, so the value of their bond portfolio dropped because if you had to sell it, you'd have to sell it for a lot less so people could get that higher yield that was out in the market. Silicon Valley had that problem, but then so did First Republic, and so did, what was the third one that was?
Signature.
Signature. So is there a system, and I've also heard there's like $600 billion of loss in the banking system from that same phenomena. Do we
Well-
need to worry about the other shoes to start dropping?
I mean, that's really hard for somebody like you or I to say for sure. I know Grunberg said something about that. and I
Grunberg
bet,
is who?
FDIC chair.
Okay.
And I bet he'd like to walk it back. I don't know. But, you know, if you look at unrealized losses without the hedging, yeah, there's certainly a whole bunch of people holding long-term bonds. Now, if it's hedged properly, it's not as big of a concern. And if you don't have runs and you don't have to sell at a loss, it's not as big of a concern. Because if you hold those assets, you're not going to lose the principal. And so now that's another question, though. Why are they all holding that? Well, that's a regulatory problem. Like
I think they were encouraged to hold those bonds.
No thinking. Yes, they were.
So let's
Most banks look like that now
let's-
because
so
of the
does the Federal
regulations.
Reserve.
Oh yeah. Most
So
banks look like that.
let's do another question. I don't know that was on my list, but here's what's happened. We've had, I said, can the Fed stop inflation? I think part of the root cause of inflation is not the Fed, but the massive federal spending.
Yes.
The
Yes.
$6 or $7 trillion dollars. And the way they paid for that was not through raising taxes or because they had money on hand. They borrowed money.
That's right.
Treasury issued bonds.
Yep.
The Fed bought those bonds, about half of them, and commercial banks bought the other half. And the commercial banks bought them at the urging
Yeah.
of the Federal Reserve.
Well,
Is that I'm
even without
I'm not day to
direct-
day on
yeah.
this, but that's my impression about what happened.
I mean, even without a direct urging, there's every regulatory reason to hold those safe, quote unquote, safe assets. The
Yeah.
whole system is geared toward holding more of those safe assets. And you also had regulatory requirements requiring more safe assets. So even without a directive from the Fed itself, you have these regulations that require that. And then, I think but this is, you hit it on the head. This is the core of this at the beginning of the COVID crisis. You have all this federal spending, all this federal borrowing and spending. The Fed accommodates it. But keep in mind, the Fed set up partly to do exactly that. I mean, they are a fiscal agent of the U.S. government. They are there to help accommodate more Treasury debt. So, yes, they bought a third of the new
Fed's not
debt.
funded by the Feds. The Fed's not funded by Congress. The Fed
Correct.
supports itself with its earnings.
Correct.
And of course, they're losing money now
They
because of
are.
these bond purchases.
Yes, they are. And because of their operating framework that pays interest on reserves.
To banks.
To banks, yes.
And
That's
so
a big
they
part
hold
of this.
reserves at the Fed instead of lending money to companies to
That's right.
promote the private economy.
That is right.
This sounds really screwed
This
up.
is a big part. It is. And this is all a continuation of what we did in the '08 crisis. So you see this expansion in '08, and it really is, at the heart of it, it's really just the same idea that, look, no matter what happens, the federal government can borrow a bunch of money and spread it around and everything's going to be fine. Well, if you do a little bit of that one time, you might get away with it. But the more of that you do, the more of the risk that you have that it's not going to work. And you saw some of that after '08 in a slower growing economy, and we've never gotten away from that. We've just kept going, and then instead of clearing it up, it was still we were still in the middle of that mess when the 2020 COVID stuff hits. So then we go even bigger. And sure enough, you've got government directives literally shutting down the economy while you're borrowing and spending all this money. So you're driving demand, you're killing supply, and it becomes a complete disaster. Yes, inflation goes up. Well, when inflation goes up, what happens to interest rates? They go up. People expect prices to go up. So anybody who's doing anything in the financial markets,
You're lending money, you got to get a higher rate.
That's right.
Yeah.
So rates go up. And you can see it. Rates went up.
Yeah, mortgage rates have more than doubled.
Yeah. And rates started going up before the Fed started raising its targets. And that's an expectation and economic effect that they don't have control over.
This is the Bill Walton Show. I'm here with my friend Norbert Michel with Cato Institute. And I set out at this episode saying we're going to take complicated things and try to understand them in ways we can all understand. And I think where I'm going with this is I'm getting more, it's getting very complicated, but I do think we have to keep pressing forward, because if we just ignore what we think is complicated, it can really end up hurting us.
Yeah.
And
Yeah.
I want to talk about central bank digital currencies, which I think is one of the things that can really hurt us.
Yeah.
But before that, we touched on something that I think is called modern monetary theory,
Yes.
which I think is the label for what you just described. Let's talk. What is that?
It can be, but it doesn't have to be. So you can have all this borrowing and spending without doing the modern monetary theory version. But the MMT version would say that, you need to do a lot of that. You need to do a lot of borrowing and spending, spreading money around to get whatever economic outcome we want. And if there's inflation, you need to increase taxes to counteract that inflation. And you can just sort of steadily manage the economy and make up for any of the private shortcomings or the shortcomings in the private economy with government spending. And it's sort of, there's some technical issues here, but it really is sort of just like the basic post-war Keynesian idea writ large.
The government can do anything.
Yeah.
But I want to get to CBDCs, but it also leads us to the dollar status as the world reserve currency. We enjoy an enormous gift because that's the case. We can run massive trade deficits, and we can run massive federal budget deficits, and really don't have to pay the price as long as everybody's forced to hold dollars.
Yeah. And they want to hold dollars, so we do sort of have this curse. We can borrow like crazy right now because as messed up as our system might be, and as much as you and I might not like it, compared to a lot of other countries, the dollar is really good. Our property rights, our wealth, it's really high. So people want dollars. Our government, as much as we might not like some of the things that they do, much better set of
Well, it sounds
right
like we're in sync
protections.
on the idea that, people are now, Tucker Carlson did a show recently about what Biden's doing is really jeopardizing the dollar status as the world reserve currency by politicizing it, and I think he is doing that. But I think the thing, and you're touching on it, the U.S. economy is still about a quarter of the global economy.
Yep. Yeah.
And another quarter of the global economy is China.
Yeah.
Well, who on earth wants to hold Chinese currency when you've got it controlled by the Chinese Communist Party?
Right.
So technically, there should be another currency that's rivaling the dollar, but because it's China, it's never going to happen.
It's not. Certainly not at the moment. I mean, I hate to say never, but yeah.
And
No,
then,
certainly
so,
not in the near
so
future.
the dollar is about 58% of the world reserve currency right now, and it's fluctuated from 90 to 40 and, somewhere in there.
Yeah.
The euro is only about 20%.
Yeah.
And the euro had a chance to become more dominant, but then they blew it with their banking crisis.
Yeah.
And so you're really left with no place else to go. I mean, the UK is about 5%, Japan's about 5%. Japan is a demographic catastrophe, and it's had. So you look around the world, there are a lot of places you don't want to put your cash.
Right. Russia, like, no, you probably don't want to do that.
So what we're saying is that since we're doing a terrible job, but everybody else is doing worse.
Worse. Yeah.
So you're not as
so
worried
we're-
about the global reserve currency status for.
I'm not.
Yeah, neither am I.
No, I'm not. I mean, I think that it's an artifact of how good we are relative to everybody else, and that's really it. And I would make the argument that we want to be careful and we want to do things to preserve how good we are, but I would want us to do better, So, but making that the principal driver of our policy is probably not a good idea because it does come with a downside. A self-defeating downside.
So let's talk about what we are concerned about, which is a central bank digital currency. You just published a paper
Yes.
a few days ago. What's the title of it is?
Oh man, I don't know
Somebody
if that
else
one
gave
was
it the title, but anyway.
Yeah, I don't know if that one was the risks of a CBDC or something along that.
Anyway, it was a comprehensive
It is.
view about it. So it's on the Cato website.
Yes. My colleague Nick Anthony and I wrote it,
Okay.
and it is a comprehensive look at both the supposed benefits and risks of a central bank digital currency.
What are they?
And you want me to do both benefits and risks?
Sure.
Okay, so what you hear from the central bankers or the government officials that want to do this is that it's going to do things like improve financial inclusion, improve payment speed, improve anti-money laundering capabilities, improve monetary policy. Those are off the top of my head.
We have a cartoon I want to put up
Yeah.
on the graphics. So Kenny, when we get to this, there's a cartoon which explains the benefits, and it's just this narrow tunnel vision of convenience. Anyway, continue. So we'll use this as a graphic.
Okay. Oh, no. And so there's this laundry list of these kinds of benefits. And what they don't really tell you is that if you want those benefits, you have to do kind of all kinds of other things, and you have to do all these things at once, or you don't get those benefits. And that's where the risks come in. And the risks are that you will have the central government completely in control of your money. And when I say completely in control, I mean
So
completely.
So it's pretty simple. There are all sorts of variations on it, but in essence, you're no longer checking with the local bank or Citigroup. You're checking with the Federal Reserve. You're checking
That's right.
accounts with the Federal Reserve.
That's right. That's right. And they might tell you that we'll just set up a bank so that it can be there's an intermediary in front of it.
Yeah.
You just deal with Citibank. Don't worry about it.
It's like
That's
College
not
Rush. They put
okay.
up the
Yeah,
facade, but
yeah.
behind it is the
It's the
real
Fed.
story.
Yeah. So imagine your cash, right? Our paper dollars.
Yeah.
So technically, those are liabilities of the Federal Reserve, but that really doesn't mean all that much because they don't have to do anything. If you have the dollar, you have the dollar. It's kind of like an IOU nothing. The only thing that the Fed's responsible for with that is printing more of them if we need them in circulation. But with a central bank digital currency, it is a digital version of that is a liability of the Fed, and now it means something. Because now it's on the Fed's balance sheet, it's not on a bank's balance sheet, and now the Fed has to provide an electronic mechanism for you or I to use that dollar.
Really?
Yes.
So they approve, so they can, they've got a document of every transaction.
Yes.
They fully control every penny, really. So they can say, we don't want
Yeah.
you spending money on, let's say, guns,
Guns, cigarettes, alcohol,
diesel fuel, any of the
fried
non-woke
food,
activities.
Yeah, anything really, anything. And so like when they say things like it's going to help us improve monetary policy, what does that mean? Well, that means the Fed can look out and say, well, we think spending is too high. We need to have less spending in the economy. Well, how do you have less spending in the
Are you
economy?
kidding? So they could
You
block
stop people
access
from
to our
spending
money?
money. Yes, yeah.
So you
yeah.
thought you had $1,000, but we're only going to let you spend 800?
Exactly. Yeah, no. And this is
I
not.
mean, this is tyranny.
This is, oh yeah, this is not some kind of like 1984 or conspiracy theory stuff. I mean, this is real. This is exactly what these guys talk about. We have another product, digital product on the website at Cato where we have quotes, direct quotes from federal and from, international government officials talking about how great it is going to be to control what everybody does with their money. So this is real. This is
This
coming.
is real. And Lael Brainerd was the
Yes.
woman at the Fed. She's now moved onto the White
She's
House.
NEC.
Isn't she next in line to
National
be Treasury
Economic Council.
Secretary?
Well, I mean, she's talked about it in that regard. She's
Okay, well, maybe
she's an
not.
acolyte
Anyway,
of
so,
Yellen.
but there are advocates in the White House right now pushing this.
Oh yeah, no doubt, no doubt. And this is an interesting thing. I keep hitting your mic. This is an interesting thing when we talk about the Fed. There are people in the Fed who don't want a central bank digital currency, and quite frankly, I think Jay Powell is one. And this isn't about our lunch. I just don't. I think from
Your lunch
statements-
was completely off the record.
Completely off the
Nothing you're
record.
saying has anything
Nothing
to do with that lunch.
No,
Okay.
nothing to do with that lunch.
All right.
Public statements only. I think he wants nothing to do with a CBDC.
But Janet Yellen does.
She does, and Lael Brainerd did.
Yeah.
So I don't know who's left at the Fed in DC on the board who wants it, and maybe
Virtually
some
the
people
last
in some of the
person on
district
the planet
banks
I
want
want in
it,
charge of my
but
money is Janet Yellen.
yeah, no, that would not. It would not be good.
So they can freeze your funds. Now, it also links into the Chinese social credit system.
Yeah. Well, I mean, so they have a central bank digital currency, and that's what they do with it, right? So they're experimenting with looking at what you're spending on, and if you have good social credit score, you get to spend some more. If you have a bad social credit score, you get to spend some less. So it's programmable in that manner. And this isn't something that you would want a free society to emulate. This is something you would want a free society to run away
Well,
from.
let's do a working example from today's headline, January 6th. Anybody involved in January 6th, if we had CBDC, they would have all their bank accounts cut off.
More than likely, yes. And you saw this happen in Canada.
Yeah, when the truckers
trucker protests,
were
right.
what were they? The
They were-
vaccine man, whatever.
They were protesting COVID shutdowns,
yeah,
or
yeah,
vaccine
something.
mandates, yeah. And so we could already have that happen. As Canada shows, you don't need the central bank digital currency to do that, but the central bank digital currency makes it a lot easier. And for the central bank digital currency to truly work, you have to take other options away from people. So they'll say, well, no, we don't want to take away your cash. We just want to have this other option. Well, if I have cash as another option, then I don't care what you do with your CBDC, right? But the only way that works from the policy perspective is to make sure that you don't have any other options, because that's the only way that you can force people to behave a certain
let's
way.
talk about other options, because the thing that's happened in the last 20, 30, 40 years are non-bank financial intermediaries. They're, both
Yeah.
both on the internet and real, with storefronts. And then we also have cryptocurrencies. And so those are out there. How do those two pieces interact with this?
Well, those two things together, and I'd say the non-bank probably to a greater degree, have had an effect on what the Fed can and can't control.
Because you mentioned Fed controls credit.
Yeah.
I don't think so.
Not
as
to the
much,
degree they used to.
because there's
That's
a lot
right.
of
No, that's
non-bank
right.
financial credit providers. I ran one of them.
That's right.
And so you don't need to go to your bank for risk capital. You can go to one of them.
Yes.
And they're like, what, half of the market now?
Yes. Yes.
So when we
it's
talk
gone
about
to- it's
banking,
gone further that
there's
way,
a
yeah.
big chunk of
That's
the
right.
market that's not banks.
That's right. That's right. And now you also see these new alternatives, crypto coming up. That hasn't taken off yet to a degree that
Well,
it would.
nobody understands
But
them.
right. But it's early, and I think the way that we
Sam
say,
Bankman-Friedman understood them.
yeah, he really messed this up on that. So you just can't trust some people. But the way that we should look at this is that we should have more private alternatives, and we should have a regulatory and legal framework that makes it easier and makes it easy for people to use those alternatives for money as they see fit. So whether it's crypto or gold or whatever people want to use, they should be able to do that.
We talk about fiat currency, as I've said, there's a long list of complicated things. Fiat currency is basically money that's not backed by anything.
That's right.
And a friend of mine who's a gold bug gave me this terrific book, and it's compilation of all the failed fiat currencies over the last 4,000 years, going back to Egypt and China and India and all that. And governments are always trying to get you to take paper that has no backing,
Oh yeah.
and they've all failed.
Yes.
And we're looking at a fiat system right now, not only the U.S. but worldwide.
Pretty much everywhere.
Should
That's
we
right.
be nervous?
That's right. I wouldn't be nervous simply because of that. And the reason that, and this is where I get in trouble with the gold bugs, because as appealing as that system sounds and as good as it did for a while, it too failed. And to have it work, you would need governments to cooperate. And at this point, you would need people to understand gold and recognize gold as money. So I don't think that's something that we should shoot for, but I do think that we should just let people decide. I think people should have alternatives, whether it's a crypto, whether it's a stable coin, whether it's some kind of gold-backed credit card or whatever it is. I think, but that's the thing that we don't have now, and that's the thing that we need.
So that's a Cato recommendation.
Yes. Yes. And I actually made that recommendation even when I was still at Heritage and in another lifetime.
Well, that counts.
But so I'm consistent on this. I think this is the way to go. I think this is you do have a public-private relationship with money already. And people don't think of it this way, but when you go to a bank and you make a loan, that is private money creation. What we would allow people to do is create whatever kind of money they want when they do that. And that's, you don't have the legal and economic incentives yet to do that. There are some that are there, but there are some very clear economic hurdles to doing that. Regulation, anti-money laundering is one that gets thrown up in front of it. You can see what the government's trying to do right now, Biden administration, to try to stop crypto. They're scared of that. They're scared of it becoming something that threatens the dollar.
What do you make of the fact that
I think that's
the Chinese are now allowing all the crypto companies to begin to thrive again in Hong Kong?
Oh, okay. So now you're
You-
ahead of me there. I know
yeah,
that
no,
they've banned them in China, and I know that.
Well, they banned
but-
them, but I think
okay.
now they're making mischief.
Okay.
Now that we're having our own banking issues,
Okay.
I think they clearly don't want it they're not going to let it happen in China.
Okay.
But they'd love to have it happen
Somewhere else.
every place else so that they can be disruptive.
Yeah.
And they're really in Hong Kong, which is no longer free, now really been tucked into Chinese Communist Party. China. That's a mouthful. Anyway,
Yeah.
CCP. I think they're out mischief making.
Oh, okay. No, I didn't hear this. I didn't realize that was a thing. I'm not saying you're wrong. I just didn't. That one's new to me.
Okay, well,
But the more private alternatives we have to the state-backed or non-backed currencies, the better. And I think that's a policy goal that's worthy of having, which is to have a framework that allows those things to flourish.
okay, we've got to wrap up.
Okay.
Let me direct us to some reading assignments. So if we've ticked off people's interest in this and you want to follow up, we can't cover all this complicated stuff in 40, 45 minutes. What should people be reading?
The first place I would go, and it'll have a whole bunch of other things that you can read, is Cato's, it's my group's, our CMFA, Center for Monetary and Financial Alternatives.
Right.
We have a policy guide for the 118th Congress, and that's on the web. So
Okay.
it's called Sound Financial Policy.
Good.
It's on our website. And if
Okay.
you just find me on the website, you'll find all of this stuff.
Well, that's why you're here. I
Yeah,
sort of
yeah.
count on you to give me a libertarian free market view about what our money ought to be about. So thanks a lot.
Thank you. Thanks
It's
for
really,
having
it's
me.
really fun. So anyway, we've this has been the Bill Walton Show with Norbert Michel of the Cato Institute, and we've been trying to talk through and think through our money and what we ought to do with it. And I think he's pointing us in a great direction to take a look at the Cato website if you really want to dig into this and learn what's at stake. And there's a lot at stake, particularly with the central bank digital currencies. That's something we cannot let happen. So anyway, hope you enjoyed our show. And as usual, we welcome your comments either on Substack or on the website or on YouTube or Rumble or all the other podcast platforms where the show appears. We take your comments quite seriously. We like to do shows that you're curious about and talk with people you're interested in. So send us your comments, and thanks for joining, and we'll be talking with you again soon. So take care. I hope you enjoyed the conversation. Want more? Click the subscribe button or head over to thebillwaltonshow.com to choose from over 100 episodes. You can also learn more about our guest on our Interesting People page. And send us your comments. We read every one, and your thoughts help us guide the show. If it's easier for you to listen, check out our podcast page and subscribe there. In return, we'll keep you informed about what's true, what's right, and what's next. Thanks for joining.